My name is Anisah binti Iznul Hisham. My ID number is SIB220703000.
Hi and Assalamualaikum everyone. My name is Amelia Natasya and my ID number is SIB220700267.
Hi and Assalamualaikum. My name is Athirah binti yamani. My ID number is SIB220700261.
Najib and Abdul Rahim, and my ID number is SIB22070150. And I'm going to talk about question 1, which is the ratio for Seri Maju Sendiri and Berhad. For current ratio, Seri Maju have a 3.81, while average industry has 2.5. Since 3.81 is more than 1, so it is able to meet short-term obligation, but compared to average, it has a better performance. Next is inventory turnover. Seri Maju Sendiri and Berhad restock 2.66 times in a year, and it has lower total inventory turnover compared to industry average, which is 4.5 times. For SCP, industry average has the fastest period of collecting debt, which is 80 days, compared to Seri Maju average collection period, which is 101 and 66 days. Next, non-current asset turnover. Seri Maju Sendiri Berhad has more effective in non-current asset turnover, which is 5.36 times compared to industry average, which is 4.1 times. Total asset turnover. Seri Maju Sendiri Berhad has lower total asset turnover compared to industry average, which is 1.5 times. Seri Maju Sendiri Berhad has a higher debt ratio compared to industry average, which is 22%. Next is time interest earned. Ability of Seri Maju Sendiri Berhad to pay interest expense in business is higher than industry average. Next, net profit margin. Seri Maju Sendiri Berhad has lower profit margin compared to industry average to generate net profit from sales. Next is return on asset. Return on asset Seri Maju Sendiri Berhad is 12.61%, which is lower than industry average. Lastly, return on equity. Seri Maju Sendiri Berhad has lower ratio in making return in equity, which is 17.78% compared to industry average, which is 19.23%. For question 1, number 2, I will briefly explain about the areas of the firm. For liquidity ratios, measure a company's ability to meet its short-term obligation. Two common liquidity measures are the current ratio and the quick ratio. Next, leverage ratio. It shows how much a business has borrowed to fund its investment. Two common leverage ratio are the debt to equity and debt to asset ratio. Next is profitability ratio, is a measure a company's ability to generate profits. Two popular profitability measurements are return on equity and return on asset. Lastly, asset management ratio. It measures how effectively a company is managing its asset. Two common asset management ratio are the inventory turnover ratio and the account receivable turnover ratio.
For the weaknesses, the first point is average ratio. Seri Maju Sendiri Berhad high debt ratio indicates heavy reliance on debt financing, potentially increasing financial risk, while a weaker leverage ratio suggests lower dependence on debt, which can be a strength. Next, second point is high debt ratio. High debt levels increase financial risk, making it harder to meet obligations during tough times and hindering cash surplus. Excessive debt can negatively impact stockholders and lead to credit downgrades, while too little debts can also raise concerns. A highly leveraged company may struggle to adapt to market changes and raise capital during economic uncertainty. For the last point, profitability ratio. Seri Maju Sendiri Berhad demonstrate weaker profitability compared to industry average, suggesting lower earnings relative to revenue, assets, or equity. Move on to the next point, which is recommendation to improve. The first one will be liquidity ratios. Optimizing account receivable (AR) management is crucial for improving liquidity ratios, which enhance shareholder wealth. Streamlining the collection process accelerates cash inflows, enabling the company to meet short-term obligations, reflecting financial strength and contribution to increase shareholder confidence and value. Secondly, leverage ratio. Businesses use protection tools like swaps and hedges to handle risk from interest rate and currency changes, helping them navigate challenges effectively. And the last point is asset management ratios. Companies boost profitability by cutting costs, working efficiently, and smart pricing. This leads to better earnings, attracting investors, and increasing shareholders' wealth through dividends and market value.
The financial statement indicates that Wingstop experienced a positive growth trend in annual revenue. In 2020, the company generated $0.248 billion, and by the end of 2021, their annual revenue increased by 13.54% to reach $0.283 billion. This suggests a healthy expansion in their financial performance over the given period. The growth might be attributed to factors such as increased sales, market demand, or successful business strategies implemented by Wingstop during that time. The data reveals a robust financial performance for Wingstop. In 2021, the company reported an annual revenue of $0.283 billion, and by 2022, this figure experienced a remarkable surge, marking a substantial 26.56% increase to reach $0.358 billion. This substantial growth suggests that Wingstop not only sustained its positive trajectory from the previous year, but also intensified its revenue generation, possibly due to factors like increased customer demand, successful marketing strategies, or expansion effort. The financial data illustrates a significant expansion for Wingstop. In the 12 months ending September 30, 2023, the company's revenue surged to $0.438 billion, marking an impressive 34.86% year-over-year increase. This growth is particularly notable when compared to the annual revenue of $0.358 billion in 2022. The substantial percentage rise suggests that Wingstop sustained and even accelerated its positive momentum, possibly driven by factors such as increased consumer was $0.024 billion, and by the end of 2021, it surged by 83.03% to reach $0.042 billion. This considerable increase suggests that Wingstop experienced robust financial growth, potentially driven by factors such as increased sales. The growth in net income reflects positively on Wingstop's ability to generate profits and adapt to market conditions. Wingstop's financial trajectory shows a continued upward trend in 2022. The annual net income rose from $0.042 billion in 2021 to $0.053 billion in 2022, marking a 24.12% increase. While the growth rate is slightly lower compared to the previous year, it still signifies positive momentum in the company's financial performance. This sustained improvement may be attributed to effective business strategies, increased demand for Wingstop's products, or other factors contributing to enhanced profitability. Wingstop demonstrated strong financial performance in the 12 months ending September 30, 2023, with a noteworthy net income of $0.070 billion. This figure represents a remarkable 63.22% increase compared to the annual net income of $0.053 billion reported for 2022. The substantial year-over-year growth suggests that Wingstop's strategic initiative, market positioning, or operational efficiency measures have been effective in driving higher profitability. The data suggests that Wingstop experienced a 9.05% growth in annual operating expenses from $0.192 billion in 2020 to $0.209 billion in 2021. This increase highlights a rise in the costs associated with the day-to-day operations of the business. Understanding the factors contributing this growth, such as investment in expansion, marketing, or operational improvement, would provide insights into how Wingstop managed its resources during this period. The financial data reveals a notable increase in Wingstop's annual operating expenses. In 2021, the company reported operating expenses of $0.209 billion, and by 2022, this figure witnessed a substantial surge, marking a significant 27.23% increase to reach $0.266 billion. Such a rise indicates that Wingstop experienced a considerable expansion in the costs associated with day-to-day operation. Last but not least, the financial data underscores a significant uptick in Wingstop's operating expenses. Over the 12 months ending September 30, 2023, the company reported operating expenses of $0.326 billion, reflecting a substantial year-over-year increase of 31% from the $0.266 billion reported for 2022. This notable rise indicates an intensified commitment of resources to the various facets of Wingstop's operation. Analyzing the drivers behind this increase, such as investment in growth, marketing, or other operation aspects, will offer more detailed understanding of how Wingstop strategically managed its resources during this period.
Factors that contributed to any significant changes in these financial metrics. First, revenue growth, market demand, and product innovations. Wingstop's revenue growth might be attributed to the company's ability to meet and exceed customer expectation. Understanding market demand and introducing innovative menu items or promotion can attract new customers and encourage repeat businesses. Next, cost management. Efficient supply chain. Wingstop's ability to manage costs might involve optimizing its supply chain, negotiating favorable agreement with suppliers, minimizing waste, and improving distribution efficiency can contribute to effective cost management. Thirdly, market demand, consumer insight. Wingstop's responsiveness to changing consumer preferences is crucial. Regularly gathering and analyzing consumer insight, feedback, and market trends can guide strategic decisions and ensure that the company's offering align with customer expectations. Last but not least, operational efficiency, technology integration. Adopting cutting-edge technology solutions can enhance operational efficiency. This might involve implementing point-of-sale system, online ordering platform, or automatications in kitchen to improve order processing and reduce operational bottlenecks. For the last factors is expansion strategies. New store openings. Opening new Wingstop locations, whether domestically or internationally, is a key expansion strategy. Selected strategic locations conducted through market research and adapting the restaurant format to suit different regions can contribute to successful expansion.
Let's make comparison between analysis and interfirm comparison. So I will start with trend analysis. Definition is a statistical method used to evaluate and predict the directions of set of data points over time. It involves identify patterns and tendency in data to make informed prediction about future values or behavior. So for focus, trend analysis is focus on recognizing pattern and shift within historical data to identify directions, momentum, and potential future outcomes of specific variable or set of variables. It aims to uncover underlying trends, patterns, or anomalies that can inform decision making, predictions in various fields such as finance, economy, and market research, and the purpose to gain insight into the historical patterns and behavior of a data set. By identifying trends over time, it helps in making informed predictions and strategy decisions. This analysis is valuable. Purpose to gain insight into the historical patterns and behavior of data set. By identifying trends over time, it helps in making informed predictions and strategy decisions. This analysis is available for business, researchers, and decision makers to understand the past, anticipate the future developments, and mitigate risk and capitalize on opportunities. So, application trend analysis is like looking at how things have changed over time. People use it to predict a future trends and make a better decision in areas like finance, business, health, and more. For example, stock price, sales retail, or social media engagement over time to understand the patterns and predict future trends. So, for definition, interfirm comparison refers to the analysis and evaluations of financial or operational performance metrics between two or more different companies. This comparative analysis helps assess the relative strengths, weakness, and efficiencies of various firms within the same industry and across a different industry. For the focus, it is focusing on comparing key aspects such as financial ratio, operational efficiency, market position, and strategic approach among a different company. The main objective include identify best practice, benchmark performance, and gaining insight to improve decision making and competitive within the industry. For the purpose to gain a valuable insight into a company performance by evaluating its metric against those of other firms. This analysis helps identify areas of strengths and weakness, benchmark performance, insight strategy planning, and adopt best practice, ultimately leading to improved decision making and competitive within the industry. For the application, have ability to empower company with insight for strategy decisions making, be it through financial analysis, operational efficiency evaluations, benchmarking, or guiding investment choice by assessing performance relative to industry peers. For example, comparing the debt to equity ratio or two pharmaceutically company to assess their financial leverage and risk profile. So, for inherent problems and concentration of ratio analysis is first, historical data. The problem is ratio really on historical financial data which may not capture a company current or future circumstances. For example, if a company has recently undergone a significant change in strategy, such as entering a new market or launching a new product line, historical ratio may not accurately reflect the potential impact on future performance. Second is industry variations. The problem is different industries have distinct norms, making it challenging to compare ratio across a sector. For example, a high inventory turnover ratio, which is generally favorable, may be typically in the retail industry but may indicate supply chain issue in the manufacturing sector. Comparing this ratio without considering industry context could lead to misinterpretation of financial figures over time, affecting the accuracy of ratio. For example, if a company assets are state a historical cost, inflation may lead to undervaluations on the balance sheet. Consequently, return on asset ROA ratio may appear higher than they actually are due to the lower reported asset value. So, lastly is different in account method. The problem is if vary accounting method among companies can hinder accurate ratio comparison. For example, company can use a different depreciation method, straight line based decline balance, affected the reported value of asset, and equity disparity can mislead analysts when the comparing return on equity ratio as the underlying equity figures may not be directly comparable. In addressing this problem, analysts must exercise continue and adopt a ratio analysis to the specific circumstances of the company and industry. They may need to adjust historical data and inflation, consider industry benchmark, and standardized accounting method to ensure meaningful and accurate insight.